a direct call and then by buying a spread. What is the difference that you get in direct buying of a call? Or instead of that, if we alternately take a put option or a call option spread, then in that case, what effect it has? So this is what we are going to see today. And so let's look at first of all what we mean by time decay and how time decay differs for near options as well as for further options. Okay. So now let's look at this. Now this is the NSE website, and you get prices. This middle level is the strike. No, the middle column is the strike, and we have already explained to you what you mean by strike and all. So probably you can just go through our previous webinars. And the strike is in the middle column, and then we have the call on this left side, and then the put on the right side. Probably I will explain to you the prices here because it is in a white background. So if there is a lack of clarity, I will just explain to you. Now this is for the end of this month, that is for the 25th expiry. The prices are mentioned. Now 10,000 call option is mentioned as around 193 rupees. And 10,000 put option is given as 250 rupees. So this is the price as on today's close. Now if you look at it, the maximum open interest is also at around 10,000 call, and the maximum open interest is also approximately there. There is also 10,000 put, and then we have 9,600 put and 9,500 put. So we have got the maximum amount of open interest is there at 29 lakhs 42,100. It is there at around 9,500, which gives us some indication that 9,500 can be a very effective support. This just gives an indication. And similarly here, I think the 10,000 call has got a lot of open interest. So it also gets us a feeling that probably we could see the 10,000 call also being a major resistance. 10,000 area being a major resistance. So we get just an impression, not necessarily that it should completely hold, but I think if you look at what's the likely range for this week, in order to measure some estimate of what the likely range, probably it could be between 9,500 and 10,000. So this is the basic assumption that we can make from the open interest position. Now having done this, we know that the present call price is 193 and present put is 251 rupees. So what it means, right now the Nifty futures is 9,970. So the Nifty futures right now is 9,970. Okay. Okay. Now the call option price and put option price, we saw the call option for 10,000 at 193, right? So this is 193. So what does it mean? Now, a basic understanding of this is that you know that if at all if you're going to buy a call option, that means you're bullish and you're expecting the market to move about 10,000. Now, this 10,000 strike, when you say it is going to be 193, your break-even price is 10,000 plus 193. 10,193 is your break-even price, right? So this is your break-even is 10,193. 10,193 is your break-even price. Now let us say the market moves up and down and you are neither taken profit nor you have closed this position. So on 25th of June, if the market comes closer to 9,970 on expiry date, say on 25th, the expiry date, the price is around 9,970. Then in that case, what will happen? This call option, will it be valued at 193 on the last day? It will not be. Just before expiry, this could be 40 rupees or 50 rupees or 60 rupees. That's all. So that means what has happened is, from 193 when it goes down to 0, let us say on the expiry date, the market just closes around 10,000. Then this call option will expire worthless, right? If it is below 10,000 or just at 10,000, this call option will expire worthless. That means 193 rupees is gone. So in a normal understanding, that means this 193 rupees that you are paying, basically you are paying as a time value. There is no intrinsic value, you are just paying for the time. And when you are paying for the time, you have to be extremely careful, right? So that is, you have to be extremely careful. You need this thing to work fast. That is, your view should become correct at the earliest. Your view should come correct before 25th of June. Okay, that is, market being about 10,193 should come before 25th June. Even on 26th June, if it comes, there is no point, because till 25th it's below 10,000 and 26th it rallies. That's a problem. So we need to know that how we overcome this time decay. Now what happens is, this time decay works for the near money option, for the at the money option, and for a nearby expiry. Now we have got expiries ranging from week, then month is there, then of course longer term option for even for 1 year and beyond 1 year is also there. Now of course those are not that much liquid, so they are the most liquid options are the near week, near month, maybe one more month. Now the near week, let us say this is for the second week from now, right? So what is the price now that will be going for the near week? Let us say that is for the 18th of June. For 18th of June, the price is 119. You see, the call option price is 119. Okay, so approximately let's take as 120. Let's take as 120. So for the 18th June, this price is 120. For 18th, it is 10,000 call option, strike is 120. For 25th, it is 193. Okay. Now, let us say today being Friday, and the expiry is going to come on next Thursday, that is 18th, and then the week later, 25th. Let us say on Monday, let us say the market has not moved anywhere, and on Monday, suppose if the price is at same at 9,970, what will happen? Let us look at that, for which we are going to use a calculator. Now this calculator is available freely anywhere in Google search. You can put it, download it, and for your understanding purpose you can use it, and then probably you can strategize your position. You can strategize your position accordingly. Now let's look at this particular calculator, option price calculator. It is there are many calculators. I have just taken one calculator. It's not necessary that you should take only this calculator also. And let us say this is option-price.com. So I have taken the this particular calculator. Now what is the underlying price right now? It is 9,972, right? So for the futures is 9,972. What is the exercise price? It is going to be 10,000. 10,000. How many days to expire? Today is 12th, right? So for 18th it is 6 days. For 18th it is 6 days. Okay. Interest rate we'll put 0 because we are taking the futures rate, and dividend yield for the time being, for understanding purpose, we'll put it 0. Now volatility right now, let us say we will just put some volatility and see what price we get. Let us say we put 30% volatility. Okay. And this rounding and all is for decimal, so that will not matter much. So now you press calculate. So what price we are getting? Call option price is 139. Actually the price listed in NSE is 120. So that means the volatility that we have taken is slightly on the higher side. So let's slightly reduce the volatility, right? And let's put it 28 and see what happens. It's 129, so probably we need to put as 25 and see. So it is probably 27. Okay, approximately I think 26 will work out. 26 volts will work out. Okay, so 26 volatility, IV is 26% right now for at the money option of 10,000, near at the money option. And we have got 6 days to expire. Now, today we are talking about the time value, right? So time value, if you look at it, the theta that comes here is minus 11. The theta that you can see here is minus 11. That means for every single day, okay, the price will decay by 11 rupees. Now this will exponentially increase. That is, today it is 11. After some days, so it will increase by 15, 18, 20, like that. So for Adda money option, if you look at it, the theta will decay by 11 rupees. Okay. So that's a very sumptuous amount. So just if you hold it for 2 days, and if the price stays static, assuming on Monday the price stays static, this 1/3, 120 will get down by 11 rupees. Straight away you will have 120 minus 11. Approximately it will be 109. Okay. Now, of course, there are other changes in the volatility and other things that can be there. And only just talking about the theta portion, because as the expiry comes very closer, I think the theta will play a very, very important part. That is, the time decay component will play a very important part. So for every single day it stays there quiet, you will lose something like 11 rupees, and this will keep increasing exponentially. This will keep increasing exponentially. Now let's look at the time value for slightly at the money option now, because we are going to look at what is the for at the money we have looked at. We look at slightly in the money option, and we will also look at slightly out of the money. But before we go to that, now the same 10,000 we have said the option price is 190 for 25th expiry, right? So 25th expiry is around 13 days from now. So we will just see what is the price for that theta there. Put the calculation. 181, so maybe we'll put this 27 was there for that. So approximately, yes. So now if you look at the theta is 7.79 for that. So if you look at the theta there, theta is minus 7.79. So that what does it show? That that is for expiry which is closer, that is for the coming way, the theta is more compared to the theta which is there for 25th. Okay. So the time decay works very rapidly against us if you are a buyer of a call option for at the money option and as well as for the nearby expiry. Now this does not mean that one is advantageous. I am not coming to that. I am only trying to make you understand the concepts in this, and so how to be structured. So if you buy a plain call for 25th, we are going to lose 7 rupees every day, and this is going to increase. Today is going to be 7, after 1 or 2 days this will become 9, 10, 11, like that. And for the coming week, the theta is just starting at 11 rupees. Now let us go for slightly at the money, that is in the money option. Now let us look at probably we look at say 9,700 for let us say for coming week, or for this particular day itself, right? For 9,700 we will put this calculation price and let's see what we are getting. Underlying price, sorry, okay, exchange price, I will change this. Underlying price is same, 9972. Strike price is 9,700. It is 364, but let us look at the NSE price. What is the price? Yes, the 9,700 price there is 310. So we have to make some modification for the vols 310. So that means the volatility here that we need to put should be much lower, right? So because for 13 days, no, I think this is a price that has been given for 18th. So let's look at the 25th rate. For 25th, 9,700 is given as 378. So what we have is 364. So we just increase it by 2% and see what happens. Yeah. So now let's look at the theta. The theta there is minus 7.27. Minus 7.27. So if you look at the in the money option, the theta is minus 7.27. So it doesn't compared to the at the money option, which is minus 11. This is theta of an in the money option is minus 7. So out of the money also of 300 rupees from this side also could be something like minus 7, right? So this is basically what we try to figure out in order to put our positions, in order to ensure that we structure the thing not to lose theta. That is the importance. The reason why we are trying to understand the theta is between a plain call and between a spread. Okay, what difference that is going to make? Okay, so how do we know what this particular to our advantage? Okay, of the spread, because now we have already explained to you that the spread margin has come down very significantly, and so we can use spread itself, that is the between the credit spread or the debit spread, instead of a call option or a put option. We have already told you that the margin requirement right now is only 2% on the contract value. There is no span margin for a spread contract, and there's only 2% on the sell leg, the contract value of the sell leg. 2% is the exposure margin charge. So for one spread, approximately the present margin will come closer to 15,000 rupees plus the premium that you pay. So let us look at, suppose if you are buying a call option of 9,700 and you are selling a 10,000 call option, what happens is that you are almost neutralizing the theta, because one you are buying and another you are selling. You are buying a 9,700 call and you are selling a 10,000 call. What happens? The delta is quite beautifully neutralized, because now if you look at it, that was 7, that was 11, this is 7, right? So now 9,700 call. 9,700 call. Okay, this has a theta of minus, let us say minus 8, and 10,000 call is a theta of minus 11. So, except for a small, there is still some theta left, but we will not try to do everything, because otherwise then we will not be able to get what we want. So 9,700 to 10,000, if you look at it, now the premium may be there. Now this we have already said, this premium is around 370 and this is 190, right? So approximately 180 rupees. This is 180 rupees for this. So the maximum profit is only 300 rupees. So you may think whether we should do the trade or not. That's a different thing. We will leave it there and we will look at what needs to be done for that. Okay. So this is 370 minus 190 is 180, and the theta is still to some extent it is against us, but it is better than buying a plain call. But what is it that you will say? The plain call, you will say that no, the maximum that I am going to get is unlimited. That is, you are buying a 10,000 call for 193. So if the price is going to be more than 10,193, then I am going to make much higher amount in that particular thing. But whereas in this particular case, I am only restricted to only 120 rupees profit. So this 120 rupees profit you will get even at 10,000 compared to, because here when you buy a 10,000 call, the price has to move about 10,193. So here your break even starts at 10,200, and literally in order for you to make money here, 10,000 plus 190 is 10,193, and here between 9,700 and 10,000, even if the price is going to expire at 10,000, you are going to get 120 rupees, because the premium that you have paid is 180 and you will get 120 rupees. But there, compared to this, there the price has to move about 10,320. The price has to move about 10,300. The price has to literally move about 10,300 for you to make money there, right? So whether you foresee such a circumstances before this expiry. Question is, 10,300 has been the high, recent high. So you may say that the market had a big fall. Anything can happen as we saw today. But let us say you get a feeling that 10,300, at least for this expiry, could be an important top, and you don't expect the 10,300 to be pulled out or pulled from that particular level. So then in that particular case, you can as well go for this, because even on the day of expiry, you will get some profit here. Okay, comparatively you will get a good profit here. But whereas in this case, you will completely lose everything there. Okay. So that is the basic advantage of a spread option in neutralizing the theta value to a very large extent. Here also what will happen is, see in the case of a call, what happens if the market is going to be below 10,000, you are going to lose 193 rupees. In the case of a spread option, here 9,700 plus 180, 9,880. So if it is going to be below 9,880, you will lose some value. Below 9,700 only, you will lose the entire 180 rupees. Below 9,700 only, you will lose the entire 180 rupees, right? So even if the market is 9,800, you would have recovered some 100 rupees and only 80 rupees would have been the casualty. But whereas you lose the entire 193 rupees here. So unless you foresee the reason why the market should be above 10,320 within 25th, there is no point in buying a call option here and losing all your this one, that is the potential thing of making this 120 rupees in a static market, right? So now if you look at the, I don't want to go into other concepts today, but what I'm trying to say is that up to 10,320, we have no issue on this. Now, if you look at it, this thing is that the delta is 0.7, so I think for 9,700 that is 0.5, so 0.2. Here the profit will move a little slowly. The profit will move a little bit slowly, but nevertheless, I think the profit will be you will have a better profit. That is the profit will be at a static price 9,880 to 10,000. You still make money, and about 10,000 also you make money here. But here in this case, you will make money only about 10,193, right? So if the market comes to 10,300 or so, you will make some 107, 108 rupees profit, and that is the same profit you would have made in the 9,700 to 10,000, right? So you have, but at the same time, what is it? There is some margin involved in that. Margin may be 13, 14, 15,000 rupees. Margin may be there. That's all. So not much of a margin there, and you are in a position to completely neutralize the theta value. Neutralize, not completely, but to a very large extent, you are able to neutralize the theta value here, which means that tomorrow when the market opens suppose if the market opens static on Monday, what will happen is, in this case, you will lose 11 rupees, right? Straight away, in this case, you will lose 8 rupees, because we have seen that the theta is minus 8. So if you are just buying 11 rupees, if you are just buying a 10,000 call option, then you will straight away lose 11 rupees, okay? But whereas in the case of a spread, you will lose only 3 rupees. So on Monday morning, if the market opens steady at 9,970, if the market opens at 9,970 steady, then in the case of a call option, the chances of losses are more than the case of a spread option, where in the case of a spread option, you will lose only hardly 2-3 rupees compared to 11 rupees fully in this particular case. So that is the advantage of doing a spread option. So what is very important is that we have to understand that what is the, we have already gone through this. See, already we have already taken classes of in the money option, ITM, then we have got at the money option, then out of the money option. Okay. Now, in this particular case, the at the money option, out of the money, in the money, there is no specific reason that why you should choose either one of these three. That's not the question. Is you must understand which one to use at what point of time. Now, this at the money option, if you feel the market is going to be extremely volatile, but it's going to be not much about out of the money. Let us say you're getting 400 rupees away from the present strike, and you don't expect the market to be much above 400 rupees. Okay. In that case, there's no point in choosing out of the money option and then waiting for a long period of time in order to make money. Okay. So in that case, you can always choose other money option. Okay. You can choose other money option, and probably even if it goes to place for 300, 350 to 400 rupees, if there is a chance of a profit on in that, then in the case you can always choose other money option. But whenever you choose a call option or a put option, the first thing that you should always look at it, that is, what provokes me to choose a particular type of option? First of all is that you are looking at a trend, and that trend is which side it is going to be, whether it is going to be an upside, then in that case you are going to buy a futures or you are going to buy a call option. If the trend is going to be on the downside, then you are going to look for selling the futures or you are going to buy a put. Now, having decided that you are going to buy a call or buy a put, the next step is that should I buy a call or should I buy a spread? Next question that you should ask yourself is whether I should buy a call, whether I should buy a plain call, or whether I should buy a spread. Then in this case, it will come to an estimation of the likely level. That is likely. See, always there is a chance that probably we have seen so many times the market exceeds expectations. Okay, but generally speaking, you will have an estimation based on the technical levels that you would have understood till now, that what is the likely range this particular market will have. Now, we have seen through the NSE open interest position, what is the likely range for, say, in this particular period. Then you also look at the technical levels. On the technical levels, you see the moving averages, and if you see the moving average exactly this time, the market went up to 10,300, there was a resistance from 100-day moving average and it fell from there. Immediately today, when it slumped down to 9,600 levels to find 9,000 between 95 and 96, there was a 20-day moving average to give support. Now the 50-day moving average is coming something like 9,250 or 9,300. So it very clearly gives a feeling that probably the market could be placed between in this particular range of 9.5 to 10.3. Okay, and only about 10.3 we are going to look at some extra momentum that is going to come. So in that particular case, should I buy a call of 10,000, pay 193 rupees for this expiry, and see to it that 10,300, which is unlikely to be exceeded? So should I do that? So question there is, why do you want to waste that much of money? Because this particular expiry, it may not go above 10,300. Second thing is, the estimation is based on the technical levels that you have understood from the moving averages, Fibonacci support, and also the monthly average PP, R1, R2, S1, S2. Based on all those things, you might have seen that probably in this month, the R2 would have come close to 10,190 to 10,200. So you don't expect the market to trade much above the 10,200 itself. Even that day, the aberration was there 10,000. So most of the time it was between 10,250 to 10,275. You can say the actual high, because about 12,300 did not trade much for. So 10,250 to 10,275, which was slightly above the R2 for this particular month. Okay, so that's itself is fairly a very significantly high level. So the market has retraced. So if you look at the market that is having retraced, the market has probably retraced towards the probably it could have retraced close to the pivot point. Okay, probably the market retraced, and the retracement has come closer to the pivot point levels. Now, if you look, if you know that the market, because last month was quite a bullish month. Let us say last month was quite a bullish month in the sense that the candle was quite on the upside. So now you calibrate that probably the market movement could be between R2 and PP. Let us say R2 and PP could be the range for this month. So let us say the support level comes to 9596 and the resistance is around 10,190 to 10,200. And the open interest also says it's likely to be between 9.5 and 10. Okay, the open interest also says it's going to be between 9.5 and 10. So this is the estimation that you are making. So you are bullish to the extent of only 10.1, 10.2 for this month, and you are likely to be, market can go up right up to 9.5. Okay, this is whether it closes at 9.5 or probably goes above 9.5. It's a question of a matter of this one, because sometimes it can breach on either side. So for the time being, we are looking between 9.5 and 10. So you should be always looking at putting your what I would say is that your strategy based on this estimation, and you must also know that to what extent the volatility and the time factor plays an important part in deciding between a plain call option or a put option and a spread option. Now it is up to you to decide as to whether you are now looking at there could be a short wave correction probably back to 9.5, then from 9.5 it could rally. So whether you are looking between 10,000 and 9,500 first a drop, or you are straight away looking for a rally from here, that I leave it to the individual trader's choice. But let us say, for time being, I feel the market probably, for time being at least, it looks as if from 10,000 it can have one fall. Okay, it can have one. That is my estimation, that it can have a fall, and then from there it can move. So my first thing is that there will be some resistance on the upside, and so there could be something on the downside. So I would like to look to be a player on the put side from this particular level. Say from 10,000, I would like to be a put player. Okay, so now I want to decide whether I want to go for a 10,000 put, okay, or I want to go for a spread. One. Second thing is, there are many alternatives available to me. One is, I told you that I don't foresee much of a reason as to why the market should be about 10.2. So I can always decide that I am going to be between 10,000 and 10.2. 10,000 and 10,200 put, I can probably look towards selling 10,000 put and buying a 10,200 put, so that in case if I go wrong, I don't want to be literally on the wrong side of the market. So the 10,000 put that I am going to sell right now, let's say, this I am going to do for 25th expiry, and 10,000 put we are 10,000 to 10,000, because I am expecting it to be in the downside. 193 and 10,200 is 109. So this is call. Okay, please correct it. I am going to correct it. So 10,000 call I am selling for 193. 10,000 put, 10,200 call, I am selling for some 109 or so. So I will get 84 rupees. So right now, if I do this trade, I am going to get 84 rupees, and my maximum loss is something like 106 rupees or so. So it doesn't matter. I am just doing this particular trade because I feel the market is likely to be like this. Okay. Now, the next thing is that I also feel that market can be between above 9.5. Market could be above 9.5. Okay. So what I plan to do is that 9.5. At the same time, 9.5 option is going to be quite expensive for me to do. So 9.5, what I'll do is I will buy a 9.5 call if I want. Okay, but that's going to be quite expensive. If I buy a 9.7 call also, I told you it's quite expensive. Okay, because even if the market goes to 9.5, it will bounce from 9.5. It can bounce from 9.5. So why should I now buy? Why should I buy now itself? Because I am expecting slightly on the downside. I am expecting it to be slightly on the downside for the time being. So I will just stop. If I am very conservative, I am just stop at 10,000, 10,200 call. This is what I will do. I am just leaving it there. But I want to increase my profits. I want to increase my profit. Then what do I do? Now let's look at it. I will buy a 10,000 put, because I'm also buy a 9,800 put. Okay. Now this 10,000 put price is 250, 9,800, 168. This is 250. This is 168. Okay, 82 rupees. So what we have seen there, 84 rupees we are receiving by selling that. 82 rupees we are paying. We are totally neutral, right? As far as premium is concerned, the margin is approximately the same, 15,000, approximately 30,000 rupees. So not much of a difference. Now let's say the market comes down. The market comes down. Okay, I will be delighted, because I expect the market to come down probably below 9.8. Probably below 9.8. Let us say it may go to 9.5, 9.6 once again before it starts to go back. So in that case, I will have my profits on both sides. One is I have the profit on the buy put spread. This is the buy put spread. Okay, and this is the sell leg of the spread. So this will yield some profit. At the same time, I also sold a 10,000 call, right? 10,000 call and 10,200 call. This is what I bought, and this is what I sold. Sorry, so this is what I sold and this is what I bought. This is for 84 rupees, right? So this also I will make profit if the market goes down. So absolutely not a problem. Okay, and let us say the market is almost static at that point of time. I will not lose much, because maybe the profit, the loss, some loss and time decay in this will be compensated by some thing in the time decay year. So I will not lose much. So where will I lose? I will lose only if the market starts to go about 10,200. If the market starts to go about 10,200, in that particular case, let us say this valuation I have to see what it is, and this valuation I have to see what it is, and probably come out. Probably I may lose some 92 rupees to 100 rupees. That's a possibility that I may lose something like 90 rupees to 100 rupees in this particular case, right? So I will have to keep in mind this possibility, and probably look towards doing this particular trade at this point of time, because the market has had some slump from 10,300 to 9,500, just corrected today itself on the upside. So there could be some good amount of resistance that can come, and so this particular strategy we can look towards for a 25th option, because now the margin has come down significantly. Because last week we saw what the margin was for the present circumstances and what the margin was for prior to June 1st. The same positions would have carried something like 1 lakh before, but now it's only 30,000 rupees. So you can easily afford. Question is the amount of risk that you want to take. So you even if you do for one contract, that is for small people who come, one contract, you probably, if it goes about 10,200, you just take off the positions, remove that. So you may have an 100 rupees loss, 7,500 rupees. If it comes down also, you may make a good amount of money, assuming the market stays below 9,800, you will have 200 rupees profit also. So 200 rupees profit also is completely possible. Though it looks to be a 200 rupees loss here, you can always come out, put a stop loss about 10,200. If it starts moving up above a certain extent, then you can come out of the position. You can just come out of that position and come out. So one is that you are also protecting yourself against any big possible movement, because the market is still bullish only, because we have seen the market on the weekly basis forming higher highs and higher bottoms. So any dip is likely to be bought, and we have seen the Fibonacci ratios coming closer to the 9596 and probably towards the 9394 levels. So definitely supports will come in those levels, and so a temporary dip of a week is possible towards the 9596 again before it starts to rally. So the same spread and other things we can do it on the reverse side after the market dips to 9596 levels, where probably we can just look towards selling something on the 9,400, 9,200 on the downside, and then probably we can look towards 9,600, 800 on the upside. So all those things, calculations, we can always start to look for that once the reversal starts after going down. Right now it is like this, and the biggest advantage here is that we are not playing we are only playing on the price, because when you do a option, literally a plain call option or put option, then the impact will be from three fronts. One will be the front on the price. So price movement. Then sometimes the volatility. Okay, volatility, because now if you see the volatility, right now it's 28%. 2 months back in March it was 80 plus, 85 also it went, or more than that. In fact, it went to 100 also. It went to 100 also. So there was a huge volatility, and if you see, the volatility has dropped to 28. This volatility, if things work out well, probably the volatility can even fall back to 15%, because that was the level in February. That's a normal level. So the volatility can even drop from 28% to 15%. We don't know about that, when it will come. So the spread neutralizes that probability of volatility, because you are buying one leg and selling another leg, right? So because of that, the volatility portion is also neutralized. Third effect is that we have the time decay, theta, the time decay. Now this time decay also, right now we can neutralize this. In the time decay, we are shown to a very large extent we can neutralize. When you are doing a buy and sell combination that I have told you, practically on one side you are paying a little bit of time, and on the other side you are receiving the time decay. So absolutely you are freed of the time decay portion also. So absolutely we have the time decay completely gone against us. The volatility has been more or less completely neutralized. So just we are depending only on the price action. We are just depending on the price action. That's all. So it's a very clearly beautiful strategy to do a spread without taking a risk on the volatility and the theta. If you do a plain option, plain call option or put option, you are exposed to too many risk factors. One is the risk factor on the price, another risk factor is on the volatility, third risk factor that you are going to take is on the theta. So all these things, if you want to eliminate, okay, and just depend only on the price action, then you should do a spread option. Now for the spread option, of course, you can put in always, because one is a spread option. Another advantage for the spread option is in case if things go against you, you lose less premium, okay, compared to a normal option. One. Second thing is that in the case of a sell, if you're doing a sell, like what I told you, the 10,000 call you are selling, and then 10,200 call you are buying. Okay. Suppose if you have sold a plain call of 10,000 call, you will always feel restless, because yesterday if you had sold a 10,000 put, thinking the market is going to go up, and when the market slumped to trade 9 trades, you would not have known what to do. Then you will be forced to do some mistake. Then only you will see the market bouncing back. But if you have sold a spread, even assuming you have sold a 10,000 put, and then you have sold a 9,800 put, and you have received some 100 rupees premium, and some another 100 rupees is there, then you can always wait and see what can be done. Because you can always wait and see as to what you exactly need to do, so that you will definitely look towards getting back a considerable portion of that, because you will be patient, because your risk is contained at 200 rupees, for which you have already received 100 rupees premium. Now you can if the market bounces by like this today, then you will, of course, you have nothing to regret about it. But even if it is going to go down, you know that very well, okay, this is my maximum loss, so let's patiently try to do something to recover that. And probably you may now, because the trend has gone against you, you may tend to sell something on the other side of the market also, probably the buy and the sell and buy leg. You may try to do some adjustment also on the sell or the buy side. Either you may do another option, or probably you can look towards doing something on the upside by selling a call spread. You may be trying to adjust your position in order to ensure that you are able to reduce that particular loss of 100 rupees or so. So probably you will reduce the loss for 30-40 rupees or so. Similarly, when the profit also comes, you will get some 100 rupees, or if not full the 100 rupees, you may get some 60 rupees, 70 rupees, some profit will come. So basically, you have a very peaceful thing. Maximum loss is only this much. So let's see what happens. So that is what I'm trying to say, that the spread has big advantages in all factors. One is it enables you to be patient, even when compared to plain call or put, because there the premium paid is more. Second thing is, you should be aware that the spread completely neutralizes all other problems of the volatility and the theta, and it has, I wouldn't say completely neutralizes this, but to a very large extent, only the residual factor is there as far as the volatility and theta is concerned. So a predominant portion of the volatility and theta is taken care of in the spread. You are just dependent only on the price factor. Which I think is the risk that anyway you have to take, because some risk you have to take to ensure that you make money, for which you are trying to understand the various types of trends in the market, technical analysis, to identify the trend and how to get on board with all this thing. We have seen many times of how to use all those things, that is how to use a trend analysis, how to use normal statistical analysis to figure out what it is. And today also we highlighted that how you can use open interest, how you can use the PP, R1, R2, S1. So from that you get a confidence level, right? So this month, how many times that probably it would have exceeded R2. So we have not seen the R2 being exceeded in a very considerable manner. So 10,190, 10,200 is a very significant resistance level for this particular month. So I think R2 is finished. So today we are looking at R10,000, 10,200 going above. It's going to be a very is not going to be that much of easy factor, right? So mostly the market could probably ensure that even settles down below 9.8 or so by this expiry period. It could probably even settle down, because we have seen that it could settle between anything between 9, 5 and 10. That's a possibility. I'm just only saying that's a possibility that the market could settle itself there. And now we have got a good amount of resistance coming from the 100-day moving average. So market could probably go up, go down to some extent before it takes off that. Only if it starts to take off that, the next month probably we can see some sort of a rally if the bullish momentum carries further. Then probably we could see something like 10.5, 10.6 coming before it starts to hit the 200-day moving average, which can be a major resistance. So That is how you normally, you position yourself after understanding of all the technical analysis and portion. So this is how, now using this, we may have to look at, we have already talked about, so we have gone from plain call and out, why you should use a spread. Now sometimes, generally there is a feeling that we should do a straddle or strangle. So whether we should do a straddle, strangle, or whether we should again use a spread, that is most important. We will come to that on Monday. Now the question is that we are trying to replace all expensive and all theta options which are working against us in terms of time decay. We are trying to replace that with some simple spreads. Only thing is, instead of normal this one, the premium amount, we are doing the spread. Previously the spread had lot of margin. So if I tell you that you do the spread, then you'll all be saying that no, I have to put in 50,000 or 1 lakh. Now that margin has come down. That is why we are talking more about spread today, even when compared to the plain call or plain put. Similarly, when compared to the straddle or strangle also, we should be looking to replace the straddle or strangle with the help of plain spread option, which will come on Monday. So right now it's more than 7:45. So I will take your questions now. So to get maximum profit, which one I should buy or sell? Suppose let us say you can do this. You can sell a 10,000 call for 190 rupees and sell a 9,500 put also. But anyway, that's a risky strategy. But I am just telling you where you should put in a stop loss. See, this is 25th June, right? So 10,000 call is 193, 9,500 put is 83. So 193 plus 83 you are getting 273 rupees, right? 273 rupees. So what you can do is you can do so 10,000 call you will sell 194, right? 9,500 put to sell for 84. 84, right? I think that's 84. Approximately 84. So we're getting 278, right? So your break even is 9,500 minus 300, approximately I'm saying 9,225 or so, right? Yeah, and it is going to be 10,275 or so. Yeah, right. I think this will work. This will work because if you see the this one, the last moving average that is coming right now is coming closer to 9,200 odd. That is the 50 moving average is now coming there. So normally, if you see today, whenever the moving average is touched, immediately it bounces back. So probably if it comes down to that extent, it will get support. Similarly, here the 100-day moving average is resisting. So it's a good, fantastic deal to do this particular option trade of selling 10,000 call and selling at 10 and then receiving 278 rupees. Good chance that you may have that entire 278 rupees. Good chance that you may have the entire 278 rupees also with you, and you can do this particular trade. Okay, so you can even do 1,000 contracts or so, and probably you will have a good amount of money being retained. And if it starts going below 9,225 or 10,278 or 10,280, you can always come out of that position, because if it goes about 2,278 or so, I think this 9,500 will not have value, much value. Probably it will have hardly anything. And this will have some value left there, so 40, 50, 60, 70 rupees may be there. So you can always come out. So in case if you are a little bit worried that probably it can have a big impact on that, then what you do is that you can just go and just buy maybe 10,400 call, and probably just buy something like, for safety's sake, 9,000 put. It will slightly reduce your premium, but in case for safety purpose or so. So you can do a 10,400 is 55 rupees, quite expensive if you do all this. 9,000 if you look at it is 24, yes. So 24, and this is going to be 10,400 thing is around 55. And so 55 plus 25, it will take off 18 rupees away from your thing. So if you want to do that, you can do. This is 55 and this is 25. Okay, so maybe you can just try it out. 80 rupees, so 278 minus 80 will 200 rupees. And so if it just crosses above 10,278 or 10,280, then come out, because that will have the same effect, I think, probably. So you can do this particular trade also. And because by the time if it comes to 927, 9225 or 10,275 or so, the 10,400 of this thing will have some 40-50 rupees value in that. So you will still be able to recover one of that, and probably one of this may go. But for a safety purpose, you can use this particular trade and do this trade. So this is one trade that you can think about it without worrying too much. Okay, thanks very much for participating in today's webinar. Again, we will meet on Monday, and then on that day we will discuss about possibility of straddle triangle and replacement of straddle triangle with spread option also. So thank you very much. Good day. Stay safe. Thank you.